Alguna riqueza poca del priore, dal topo puja. Ora passa appena ಮಾಡ್ಕೊಂಡಿದ್ರು ಇವನ್ ಬಂದ್ಮೇಲೆ ನೆಲಮಂಗಲಲ್ಲಿ ದೊಡ್ಡ ಪ್ಲಾಂಟ್ ಓಪನ್ ಮಾಡಿ ಅಲ್ಲೇ ಫಾರ್ಮ್ ಹೌಸ್ ತರ ಮಾಡ್ಕೊಂಡು ಚೆನ್ನಾಗಿ ಅವನು ಇಂಪ್ರೂವ್ ಆಗ್ತಿದ್ದಾನೆ.
Please mute yourself. Participants, mute yourself. Participants, mute yourself. Participants.
Hey, good morning, everyone.
Good morning. Can you all hear me?
Yes, good morning.
Good. Yeah, so wish you a happy weekend to begin with. So today I will just in the last class I kind of took you through the TRIPS agreement, a high level overview, gave you a high level overview.
Hi, a very good morning to everyone. Welcome to the third session of the postgraduate diploma in tax. We've been doing some really interesting stuff about the basics of tax, and what we have found out is that tax has some puzzling characteristics. Um, it is about earning something, but it's not clear yet to us on what basis does the tax legislation capture profits and gains for tax purposes. So we went through a series of cases last time, and we talked about realization of income and how income can be realized and cannot be realized in some situation or the other. Uh, Students, please remember we went through a bunch of cases beginning with Kika by Premchand, Shaki versus Werner, Shirin by Kuka, and one of the things that we are trying to do there is to see what is income as a concept and what are the situations in which it is realized. So that's where we were in our first two sessions. And here we are back again, trying to figure out what the concept of income is. This will be the last of our sessions on the concept of income. From next session onwards, we will be going into each of the heads of income, that is, salary, income from house property, income from business, capital gains, and income from other sources. And we'll be talking about how income is recognized, realized under each of those heads. So that'll be from next session onwards. But in this session, today's session, we will be talking about the concept of income in general, and why is that important from the point of view of both our understanding of tax law and how do we advise other people about taxes. So one of the things about this course is that it's conceptual and it's fundamental, but it's also in the end ultimately envisaged as practical. Um, there must be something in this course that enables you to take it forward in your lives, whatever else you're doing in your professional lives, whether you're finance managers or lawyers or accountants or doing any other work. It should be what we teach you here should form the basis of what you can do and how you can process it in your respective careers. So that's where we are, and it'll be interesting for us to see. I'm going to start off with a case, but before I do that, I just want to make sure that we are all on the same page. So let's start. I'm going to start the slides now, and then we'll continue with it. Just give me 1 second, please. Yeah. Yeah, can I just have somebody confirm that you can both see the slide and you can hear me, please?
Yes, sir. We can see the slide also, and you're audible.
Excellent. Thank you very much. All right. So we are in the concept of income, and we are going to start by talking about Section 2, Clause 24. Section 2, Clause 24 is the section that talks about income, and it defines income. The section is 2 Clause 24. Please make a note in the Income Tax Act 1961. And then from next year onwards, that's from April 1st of 2026, we're going to have the Income Tax Act 2025. And in the Income Tax Act 2025, Section 2, Clause 24 appears as Section 2, Clause 49. All right, so please make a note of that. Please remember, I just want to make two logistical pointers here. One is that we are at the cusp of a new legislation. The new legislation has not yet come into operation. It will come into operation only next year from April of 2026. In the meantime, we'll still be continuing with the old legislation, which is the 1961 Act. All the statutory references in this course will be to the 1961 Act, but wherever applicable, I will also mention the corresponding section in the new legislation, which is the 2025 Act. In a majority of the cases, the new Act and the old Act do not differ substantially. Where they differ is they differ in the arrangement of the sections, in the number of the sections, but in terms of substantive conceptual principles, in most of the cases, majority of the cases, there's no difference, and you will see that as we go through the course. Wherever there is a difference, I will mention, and wherever I want you to note the new section, I'll mention that as well. But since this course is a conceptual course, it's a course that's based on fundamental principles, you don't have to worry too much about the different sections in the new act, except where I mention it, so that you are aware of where those new sections are. So the Income Tax Act taxes income. Quite naturally, we would like to know what is income, because that's what's being taxed. Section 2, Clause 24 in the definition of the 1961 Act defines income, and we'll just go through that in a little bit. And this brings me to my second logistical point, which I've mentioned before, but I just want to make sure that all of us are on the same page, which is that I need all of you to have ready access to two things. One, my course materials that I prepared for you, right? That all of you must have access to, because I'll keep referring to that from time to time. So that's the first thing that I want you to take note of, right? So it's called Course Material for Taxation Law, Professor Nigam Nugehalli, and it's on Moodle, so it's available to everybody, and you must have access to it while we are doing our classes, because I'll from time to time refer you to what I've written there, or what some case law has said, etc. So it's important that you have access to it. The second thing I would need you to have access to is the Act itself, right? And the Act itself is not on Moodle. The Act is widely available. Both the 1961 Act and the 2025 Act are available online. If you just type in CBDT tax or income tax department, you will go to the Act. So the Act is very easy to access, and it's available for everybody on the web. You can read it from there, or if you prefer, if you're the kind of person who likes to have the hard copy of the Act, then please do not hesitate to buy it. You can buy it and you can use it. But either way, I need you to have access to the legislation while we are doing our studies. So these are the two things that I wanted to mention before we proceed. Just give me a second, please. Sorry. Okay, great. All right. All right. So now we're back to Section 2, Clause 24, which is Section 2, Clause 49. And it says income includes. So the first thing we notice about this section, Section 2, Clause 24, or if you prefer, Section 2, Clause 49 in the new Act, income includes, it's an inclusive definition. It's not an exhaustive definition. And whenever this inclusive definition, it means that whatever has been defined is not confined to the definition itself, that it can have a more expanded meaning. And it says income includes, and then gives a series of items. Some of the items, as you can notice, are there in the in 2 clause 24. Things like profit and gains and dividends and salaries. These are all itemized things that are mentioned as the definition of income itself. And you notice that that is still coming within an inclusive rather than an exhaustive definition. Now, why is the concept of income important? Because it's one of the fundamental concepts of income that that brings in its wake, brings with itself certain other important characteristics. For example, what's important is not revenue, but income, right? And therefore, if there is a business and there are losses and expenditure in the business, that will affect the net income of a taxpayer. So it's because we are talking about income of a taxpayer and not revenues or whatever is coming in there. We are more interested in, when it comes to income of a business, that we deduct from the revenues of the business expenditures, and we also make sure that if there are any losses in the business, they can be carried forward or carried back. Similarly, income brings within itself or with itself the idea of who owns that income, right? Who owns property from which the income is being derived, or who owns that income itself. And so there are lots of questions in tax law about ownership as well. Ownership is important in many cases. For example, if I'm earning salary, but actually it's not coming to me, it's going to somebody else, do I own that salary, that stream? If I lease land, if I rent land, then and I get some money from it, am I the owner of the land for purposes of tax? So there are issues of ownership and distribution that are important in when it comes to income tax. And then there is, of course, distribution, which is that income tax really, when it comes to talking about who is earning it, is talking about it in terms of units. So, for example, there are several units of taxation. You can be an individual, you can be a trust, you can be a partnership, you can be a company, you can be an association of persons. We'll come to all of that, what that means later. And each of this is considered as an autonomous unit of taxation. And therefore, you can have a situation where a company is earning income. It's a unit of taxation. And then when it distributes that income back to its shareholders, there is yet another another level of taxation. And so that's another issue. That is that because income has these aspects of ownership, aspect of distribution, aspect of losses and expenditure when it comes to business income, we'll see about that in a bit. Then we understand why these are fundamentally the most important concepts of tax law. All right, that's as far as the concept of tax law is concerned. And what we'll do now is we will go to our first case, which is Navin Chandra Mafatlal versus Commissioner of Income Tax. Now, this case is discussed in your course materials as Note 7, beginning with page 44. Yeah, note 7, beginning with page 44. And the issue in this case was whether a tax on capital gains was invalid as beyond the legislative power of the central legislature. This is a 1955 case, so after India's independence, and this case dealt not with the 1961 Act, but the Act prior to that. And there was a section 12B in that Act that said that there will be a tax on capital gains. Capital gains means if I sell property, it's a typical example of capital gains. And the Income Tax Act was used to introduce this new head of capital gains in the Naveen Chandran Mafatlal case, and it was asked whether the question, the taxpayer challenged it, went all the way to Supreme Court, and the challenge was whether this is beyond the legislative power of the central legislature. Question was whether the ability of the parliament to increase the ambit of income, because income they added in 2 cross 24 they included income as including capital gain, and the question was whether the parliament could do that, right? Because income generally means something that's earned from time to time. How can income be? How can a sale of a building be income, right? And the argument of the taxpayer was that taxes on income does not embrace within its scope tax on capital gains. Right? However, the court differed in its argument to state that income should be interpreted widely in constitutional context, applying a liberal interpretation to legislative entities. The court thus upheld that Section 12B as a tax on capital gains was valid under entry 54, with income including capital gains under the central legislature's authority. Right? Now, I find this case quite fascinating, actually. And it may be worthwhile for us to figure out what exactly was the court's reasoning in trying to say that the parliament could do it, right? So here's what I'm going to do. See, a note 7 is only about 4 pages, right? So I want you to take a look at this. This is from page 44, page 44 to page 48. And I want you to tell me, if I were to ask you, say in a sentence or two, to tell me what is the court's argument. Sentence or two, that's all. Tell me what is the court's, what we in law school we call it ratio, court's reasoning. How would you characterize the court's reasoning? The court has been asked to decide that can the parliament expand the concept of income to include capital gains? And the court gave an answer saying yes. But I want you to tell me what is the reasoning, the foundation on the basis of which the court gave me the answer. I'm going to give you 5 minutes. I think that's all you need. Just read these 4 pages. I'm going to give you 5 minutes. And when I come back, one of you should tell me the answer. And I prefer, I see the same 3 or 4 people talking in the class or messaging. Can I have a wider audience, please? Remember, this is just a pedagogical exercise. There's no, there's nothing, nobody's going to judge you, right? So all of us are going to get it wrong at some point of time. That's not an issue at all, but I want you to talk and interact with me, please. That'll be important for me. So 5 minutes, and we'll come back and we'll talk about what exactly was the reasoning or the basis on which the court said income can include capital gains. Okay. You must now tell me where you found the reasoning. Anybody who can start this off, please? There are two ways of responding. You can write in the chat box, or even better, you can speak. But before speaking, you must raise your hand so that I know that you want to speak. So let's see who wants to start off. The question I asked was, in a sentence or two, how did the court decide that income should include capital? Okay, so Indulekha has said that the word income in its natural meaning includes any profit or gain actually received. Hence, capital gains were also included as income. That's right. That's absolutely correct. It's got a wide meaning naturally. It doesn't only mean something that comes from some source on a regular basis. It means anything, any profit or gain that somebody has got. And what's very interesting about this case, if you go to the actual case, and you go to note 7 and you scroll through, and if you notice that I'm just scrolling through it to go to the para that I want you to read, and it says here in para 8 onwards, they talk about what is the meaning of income. And in para 10, Vivek is asking, where is the PDF? Couldn't find it. It's on your Moodle. It's online. You can find it there. And everyone should have access to it. Vivek, if you don't have access to it, you should have it. So please email pace@analyze.ac.in and they will help you. Yeah. There's another unknown user, who has said the word income in entry 54 should be understood in its ordinary and broad sense, meaning anything that comes in or any gain received. Therefore, capital gains, profits made when you sell an asset for more than its cost, are also kind of income. That's correct. If I refer you to para 10 from where this user is talking about, has got that idea. Para 10 of the case itself, where the Supreme Court is saying, what then is the ordinary, natural, and grammatical meaning of the word income? And it says, according to the dictionary, it means a thing that comes in. A thing that comes in. And therefore, in the United States of America and in Australia, both of which also are English-speaking countries, the word income is understood in a wide sense. And then they refer you to some American and some Australian cases, that you don't have to worry about that. So the idea that it's that wide, anything that comes in, is to me is quite interesting. I got another person on the chat box saying, we are not finding this material. Please email Pace. They will help you. In the meantime, I will read it out for you, so you don't have to worry about that. But after this session is over, please do email Pace. As I said, you must have access to it. If you're not able to have access to it, we can help you do that. That's not a problem. But don't get stressed about it. I'm reading it out for you, so don't worry about it. Whoever this unknown user is, I can't find the name on this, so don't worry about it. Okay, relax. It's okay. I'll read out the provisions for you, and you'll be all right. Okay. Now, what's interesting to me is that such a wide meaning of income is placed. I mean, how many of you are thinking about that? So, income is anything that comes in. I mean, is there a point to the definition of income then at all? I mean, why do we even have a definition of income? Yeah, I mean, if we have something like this is anything that comes in, and therefore capital gains. Yeah, I mean, you sell a building or you sell something. Somebody very interestingly and correctly said, capital gains, profits made when you sell an asset for more than its cost, are also a kind of income. I mean, it's correct. I mean, so you got something has come in, but then how many of you are finding it a bit odd that that we have something like this? Because if it's something like this, then I mean, if the definition of income is so malleable that anything that comes in is income, then what's the point of the definition? I mean, does the definition act as a constraint or a restraint on either the legislature or the income tax authorities? Yeah, that's what I'm trying to get at. Yeah. So the person who said that therefore capital gains profit made when you sell an asset for more than its cost are also a kind of income. If you could just identify yourself, it comes as unknown user to me here. So if you could just identify yourself either in the chat box or on speech, it'll be great. It'll be useful to know who that is. All right, so that was my my first point about the way Mafatlal went about it, and the way the income definition has been interpreted to mean that. And now we'll see the plot gets even even more interesting as we go through other cases as well. Yeah. Anybody has I don't think anyone has raised their hands so that I can see. So unless I'm not catching them, I don't think anybody has raised their hands here. So I'm going to move on to my next case. Yeah. Okay. All right. Okay. I'm just moving on to my next case. And the next case is the Commissioner of Income Tax versus Maheshwari Devi Jute Mills Limited. This is an interesting case. This is a case where all the jute mills got together and decided to voluntarily cut down their jute mill processing. And the way they cut it down was they had what was called at that point of time a first working time agreement. And under this agreement, all these jute mills decided that they will voluntarily restrict their jute mill processing to a certain limit. And so each of them, therefore, was given a certain quota beyond which they could not process jute. And these were known as loom hours. And if some members, for whatever reason, did not meet their maximum quota, could not, in fact, did less than what their quota allowed them to do, process less than what their quota allowed them to do, then the members could transfer the surplus loom hours to each other. There's, for example, a member, say he could process jute mills of, say, I'm just plucking out a number, say 100 jute, 100 loom hours was given to him, and he could only use 60 of those loom hours. For whatever reason, he didn't have enough people employed or he didn't have enough power to do it. And then he had 40 loom hours left. He could transfer it to some other person, some other factory, which actually had the capacity and wanted more loom hours. And he could get something in return for it. First question I have for you is, why would somebody do that? Why would somebody voluntarily get together and restrict themselves from processing jute? Why is that the case? Anybody here can answer that? As I said, either chat box or raise your. I'm just commercially, it's not a tax question. Commercially, I'm saying, why would it be the case that jute mills will get together and then voluntarily decide to restrict their processing? Any reason? Yes, Tanmay, is it? Who's raised their hand? Yes.
Sir, can you hear me, sir?
Yes, I can hear you, Tanmay. Yes, yeah.
Sir,
Yes, please.
it's due to, sir, as mentioned, there is a overproduction, and due to overproduction, there will be excessive supply. And
Yeah.
due to excessive supply in the market, the prices they will expect will never, they will not get the expected
I mean, the
price, there will be
prices will go down for everybody if there is excess supply. So everybody is harmed.
yes.
Now, is there a comparator to this? Any other field in which you have seen this? I mean, you got the concept right. Is there any other industry where something like this happens and people are always worried about this that you can think about? Yes, that's right. Indulekha has got that right. Thank you, Tanmay. Indulekha has got that right, and that as well. Petroleum production, OPEC. So OPEC does this all the time, right? So the organization of the petroleum exporting countries, they do it all the time, right? And there are many other markets. Royal has set up a diamonds. So the problem in some markets is that if there is overproduction, oversupply, and then an overproduction, therefore oversupply, the entire market is hurt, is harmed. And so it's better in everybody's interest to restrict the supply. Of course, if you do that through this kind of loom hours kind of thing that I'm talking about here, then you get into this kind of other issues, which is what do you do when somebody has excess loom hours, somebody doesn't have excess loom hours. So here the respondent mill sold excess loom hours in the assessment years 1949-50 and 1950-51, receiving payments from other mills for that. And the question was, the income tax officer included these payments as taxable revenue, but the respondent argued they were capital receipts. And so the question here was whether this is a revenue receipt or a capital receipt. A revenue receipt would be business income. A capital receipt will not result in income. And the court ruled that since loom hours were permanently transferred without retaining any ownership, the proceeds qualified as capital receipts, not revenue, and thus were not taxable. Right? So they were not taxable as revenue receipts. By revenue receipts, we mean business income of the taxpayer. Okay, well, good enough. But here's my follow-up question to the class. The only way I can do that is once I stop presenting. So I'm going to stop presenting for 1 second. So Maheshwari Jute Mills case, right? And you got this case, and I just told you what happened in that case. And I said that if you transfer loom hours, excess loom hours, and you get some money from it, it was not taxable under the Income Tax Act. This is a case where the taxpayer got away with it. He got some gain, and he was not taxed. But I thought, my friends, that your Mafatlal case, which is a case that happened before Maheshwari Jute Mills, had said anything that comes in, any gain you get, is taxable, right? So how is it that here they said it's not taxable? Any reason? Because here he gained something, right? So he sold those loom hours and he gained something. So how is it that, and this is a 1965 case. If you see note 8 of your course materials, it says it's 1965. Mafatlal, and this is a Supreme Court case, and Mafatlal case is 1955, right? So it's an older case, yeah. And the Mafatlal case says anything that comes in is income. How is it not taxable here then? Can somebody think about it? Yeah. How come that the taxpayer escaped taxes? Yeah. Yes, who's going to tell me? I mean, you just give me some ballpark idea, right? Why somebody asked you this question. You have a case that said anything that comes in is income, right? But then how come it's not being taxed in the Maheshwari Jute Mills case? Yeah, just speculate. No, don't worry about getting it wrong or right. That's not the purpose of this talk, right? But you got to think. The purpose is to make you think. So you tell me, either in the chat box or I hope that nobody has raised their hand because I can't see anybody raising their hand right now. So if somebody has raised their hand and I'm missing it, so you can speak up. It's not a problem. But
Sir,
sorry. You have to identify yourself first. Yeah, sorry.
I'm
Yeah,
Asha Rajiv.
Yes, Asha.
I'm Asha Raj.
Yes,
Sir,
yes, please.
he has sold his jute hours for production hours for permanent. So that much his production capacity reduces, and in future also it will be impacting him. So it is a capital receipt only there.
No, what I wanted to ask you was, Asha, take me, just answer, take me through these thought processes so that we can all be on the same page. Let's assume that the loom hours are only applicable from year to year. Let's assume that. Let's say that after year one, the loom hours are no longer applicable. It's only annual. They're basically annual periods. So, one second, Asha, let me just finish. So I have some excess loom hours that I have not been able to use. It's a waste for me because I don't have enough workers or I don't have enough electricity, enough power. So I just transfer it to somebody else and I get some money for it. You will agree with me that there's been some gain to me because of that, Asha?
Yes, sir. Revenue is there that he has sold it and he's got the amount. But to that extent, his capacity also reduces. That means there's a capital reduction also because his machinery.
Sorry. 1 second. His the facts we are assuming here is that he does not have the capital capacity to go beyond whatever he has done. He could only use 60 loom hours. He's been given 100 loom hours. He could only use 60 loom hours because he doesn't have enough capital capacity, either because he doesn't have enough employees or he doesn't have enough power or enough machinery. So it's a waste for him. The other 40, he was never going to be able to use it. And so he transfers it. Would you agree with me that there's been some gain in these facts?
Gain by revenue, yes.
Yeah.
There's a revenue receipt there.
Yes, but the court is saying that that gain that he has incurred is not taxable. Right? And what we are trying to investigate here is why is it the case that once we have accepted that there's a wide definition of income, why is it the case that we are not recognizing this as taxable under the Act? Asha, hold on 1 second, okay? Let me just go to somebody else. I think somebody else had raised the hand, no? Is it Rajanandini, is it?
Yes,
Yeah?
I'm
Yes,
Raj
please.
Nandini.
Yes, Rajanandini. Go on, tell me.
So there is actually a fundamental distinction between the revenue receipt and the capital receipt.
Mm-hmm.
So here, I suppose in this case, the loom hours are actually treated as a part of the fixed capital and
Okay.
not a part of the company's operation. So
Okay.
herein, when there is this sale of the loom hours, it is actually a partial disposal of the capital structure, not a profit there. So, and that's why not taxable.
Oh, okay. No, so I got your point. But my question was if you did not have any access to the idea of fixed assets and capital, we haven't even discussed all that in this course yet. You just had
Okay.
Mafatlal in front of you. Why
Oh.
don't you think that this is a deviation from Mafatlal a little bit?
It is in that case
Because there's been some gain, no? There's been some gain, some benefit, something has come in, as Mafatlal said, and but it's not been taxed.
absolutely it is,
Okay.
but then
Okay. So here,
yes.
so thank you, Rajnandini. And by the way, I'm very happy. Very good response here, by the way. And I'm very happy that other people, both Asha and Rajnandini, gave some really interesting and useful responses. And I want other people also to talk, please. It's really important for me. So I just want to now, I'm going to go back to the chat box in a second. But before that, let me just tell you where I'm coming from or what's happening here. What's happening here is something very interesting, which is that there is a difference between a definition of income under the Income Tax Act and another concept that we have talked about previously in the previous session called the scheduler nature of income tax. Right? So just because something comes within the idea of income or definition of income doesn't mean it's the end of the road for revenue. Revenue also has to then see whether it is taxable under one or the other schedules of the Income Tax Act. And as I said, there are 5 schedules, salary and income from house property, capital gains, etc. So this question in the schedule in the loom hours case, Maheshwari Jute Mill's case, was not a question about only a definition of income. It was actually a scheduler question, which is whether this income is taxable as business income or not. It has come in as a result of business, right? Because if we're using the but for test, but for the jute mills business, the taxpayer would not have got money for the excess loom hours. But that's not the end of the matter. What's important is in that business schedule, can you fit this income in or not? And there the question comes whether this is merely a cap, and we're going to go. We have not done that yet. We are not yet in that range yet. We have not come to that situation because we have not done it. Whether something that is anything that comes into the business, whether that can be business receipt or whether it is a capital receipt. That question, whether it's a revenue receipt or a capital receipt, is not a definitional of income question. It's a scheduler question. It's a question whether, as a result of business, we get some things. Do you classify it as a revenue receipt? Then, in which case, it is business income, or a capital receipt, in which case it is not business income and it's just merely a capital receipt, something that you get out of, as Raj Nandini said, transfer of some fixed asset. So that's the critical thing about this case, and that's why it differs from what we had discussed in Mafatlal. Now let me just go quickly through the chat box to see if there's something else that people had said. Yeah, they've said the same thing about capital gains and revenue receipts. I have one question for you, by the way. Again, this is not apparent from the case, but it's something that I think people, all of you should think about, which is, I understand that this is not business income. There's some logic there. This is some capital receipts kind of situation. Why did the court or the income tax authorities not tax it as capital gains? Because there is a capital gains head under the Income Tax Act. Anyone wants to speculate on that? A lot of people here have said that it's capital receipt. Then why can't they tax it as capital gains? Any reason? Anyone wants to speculate? Either in the chat box or if you want to speak up, that's fine as well. Except that when you speak up, could you please identify yourself so that I know who's talking? Right. Okay, I got 2 responses. Induluika is saying there is no actual capital gains in the first place, but only a revenue receipt. Okay, and there was no capital expenditure in the first place. I take you to mean that there was no capital asset in the first place, and therefore only on a transfer of a capital asset can there be a capital gains under the capital head schedule. Again, we haven't done the capital head schedule yet. I'm just asking you, in some ways I'm being unfair to you. I'm asking you to speculate without having read those provisions. But you're saying, okay, that's a good point, by the way. The point is all capital receipts can't become capital gains, can't go into capital gains head. It'll depend on what is mentioned in the capital gains head. Again, a scheduler question. And the capital gains head says that capital gains occurs only if there is a gain, as the Tandoori is pointing out, and only if there is a transfer, whatever that means, of a capital asset. whatever that means. And here, the revenue never made that argument about transfer of a capital asset, and so that wasn't the case. By the way, this was in 1940. The years involved were 1949, 50, I think, and actually, interestingly, it is during those years that there was no capital gains provision in the income tax legislation at that point of time. So that must have been the reason why the revenue didn't even bother about a capital gains uh, argument, because there was no capital gains schedule at that point of time. There's no capital gains tax at that point of time in those two intervening years, 1949 to 51. Okay, all right, that's lovely. I think we have made some progress about not just the definition of income, which is quite wide, but also about the connections between income and scheduler system. The fact that something's income is not the end of the matter. The revenue has to fit whatever item they want to tax within one of the schedules of the income tax legislation, and only then it be taxable. All right, so we'll take a break here. We'll come back and do the other cases. We'll take a 10-minute break, and then we'll come back at the end of the 10-minute break, and we will continue with a few more cases on this income, and there'll be some more nuances that I want to talk to you about. All right, see you in 10 minutes time. Welcome back, friends. I'm now going to go and talk about the rest of the cases. Before that, if anybody had any questions or follow-ups, could you please tell me? Or if you're not able to hear me or something, just let me know on the chat box. If you had any questions or comments on what has happened in the previous hour, please do let me know. Okay. Yes, Rohil.
Yes,
Yes,
sir.
Rohil, go ahead. Yeah.
Yeah.
Tell me.
So in this case, if I'm getting this right,
Hmm.
the Lumas are being traded, and this is
Hmm.
a capital receipt and not a revenue receipt.
That's right. Yes.
But as you mentioned that there's no asset being traded over here.
No, I'm saying that that issue was not even gone into by the court for two reasons. One, the revenue didn't
Okay.
raise it. Revenue didn't raise it
Hmm.
seriously. And two, I think the reason why the revenue didn't raise it seriously is because there was no capital gains schedule at that point of time. They were just intervening 2 years when there was no capital gains taxation in India. So I think the revenue wasn't too bothered about characterizing a capital receipt as a capital gain because they
Okay.
anyway capital gains were not being taxed only in those 2 years. So that's why I think it wasn't raised. Otherwise, you could say that I mean it's speculative, but you could say that loom hours is a right to something, right to produce jute of a certain amount, and that right itself is a property which can be transferred. You could make an
Hmm.
argument, but that neither the court went into it nor the revenue did raise it seriously.
Okay. So if such a case were to happen today,
Yeah.
then probably it will be taxable.
No, I think so. And also the capital gains, it'll be likely to be taxed because I think it'll be considered as some kind of a property right that is being transferred. We are going ahead of ourselves a little bit, but since you raised this question, it'll be interesting for everybody to hear the answer. The capital gain schedule says transfer of an asset. Capital asset is taxable. Capital asset has been defined very widely. Don't worry, we'll go into all of these things when we do capital gains, but I'm just giving an answer in response to your question. Capital asset has been defined very widely to include property of any type. Very likely that a loom hour would be considered as a right to produce a certain amount of jute and therefore a property of some kind which is subject to taxation. However, Rohil, now that you have raised this issue, I am going to ask you a question, which is even if that were to be the case, there may be a problem in taxing this. Why is that the case? Even if it were to be the case that loom hours were considered as a capital asset and that it will therefore be a transfer of a capital asset for capital gains purposes. And today we have a capital gains schedule. Even then, there may be a problem. Anybody, Rohil, of course, to begin with, but anybody else wants to speculate as to why that might be an issue?
So because there's no consideration paid to acquire the
No. There
capital
is.
asset.
Oh, hold on. Oh, I see. Excellent answer, actually, Rohit. When you started out by talking about consideration, I thought you meant there was no consideration paid for the transfer of loom hours, which is not the case. He got something in return for loom hours, and that is consideration. But actually, it looks to me like you were talking about how did he acquire loom hours in the first place, and no consideration payable means zero. So whatever he gets
Correct.
in return is capital gain. Then, don't you think?
No, I mean it doesn't come under the definition of a capital asset itself.
No. I'm assuming for purpose of a discussion between you and me, it'll be
Mhm.
a capital asset because it's a property of some kind, right to produce. A loom hour is a right to produce jute. Just assume for the purpose of our discussion that it'll be
Mhm.
a capital asset. Um, now, is there an issue in taxing it under capital gains? Anybody? It could be Rohil to begin with, but anyone else wants to speculate? So this is my challenge to the class. What I'm saying is, even if it were to be the case that a loom hour is a capital asset and it therefore transferable subject to capital gains, even then there may be an issue in taxing it as capital gains. Anybody? I'm being unfair to you guys. I mean, we haven't discussed this in the class yet, but it'll be interesting thing for you to fix your mind on at this point of time. Yeah. I mean, the Rohil has sort of answered the question actually in some ways when he said that, well, what is the consideration that he paid? And my response to him was, well, he didn't pay anything for it. It was just some voluntary agreement among the jute owners, but and therefore it is zero. He didn't pay anything, and therefore whatever he gets 100 rupees. It's 100 minus zero. 100 is capital gains. Now, I was being flippant when I answered it in that manner to Rohil because that is not the way income tax works. That's not the way a scheduler system works. In a scheduler system, the calculation of anything, profits and gains under the business schedule or gains under the capital gain schedule, the calculation of anything has to be certain and has to be provided for in the schedule. Right? So that's another characteristic of a scheduler system. You can't speculate that, look, since he didn't pay anything for the loom hours, the cost of that asset to him is zero. That may be a logical idea or a natural idea, but income tax doesn't follow logic and natural ideas. In Income Tax Act, in the income tax legislation, it has to be specifically provided for what's the cost, or it has to be specifically accounted for. So the taxpayers were arguing that the idea of lumos is very abstract. You can identify a concept that it's a capital asset for some vague reason, like it's a property right, but how do you value this asset? How you can't give it assign a value zero to it just because it sounds natural or logical, unless the income tax act provides for something like this, it can't be taxed. And therefore, if the calculation fails, if you're not able to figure out the cost of an asset for capital gains purposes, the capital gains schedule itself fails. You can't tax it. Now, so that's the problem. That's the challenge before the revenue, which is that how do they understand the cost in the person's hands of these loom hours? And a lot of law students that I teach find this concept hard to understand. That is, they say, isn't it logical that he paid zero for it, or there's nothing, no payment? And a lot of accountants get this immediately, which is that if you can't account for it properly and in a certain manner, if you can't calculate the gain, you can't tax it. The revenue was aware of it, by the way. So there's a punchline to this story. The revenue was aware of it, and therefore the revenue has made sure that they have a specific provision. We'll come to that later when we do capital gains. The revenue has made sure that there's a specific provision in the Income Tax Act under the capital gains head that deems the cost of loom hours as zero. They've actually deemed it. They said this is what we will take the cost as. So they were that specific because they were aware of this kind of argument that a taxpayer can make. All right, now let's move ahead. We've got other cases to do. I'm just going to share the screen and I'm going to start.
So another question.
Yes, please go ahead.
So imagining that I'm a business person and
Yeah.
I have been invited by a college
Yeah.
to, let's say, give a lecture for an hour, for which I get some sort of a remuneration. So in this case, which is similar to the Lumas,
No. It's not similar to Lumos because because in this case you are not what you're getting money for is you doing an activity, which is teaching, doing some labor, not transfer of an asset. There's no transfer of an asset. You're actually, this is a case of labor, not capital. You're actually laboring, and therefore you're getting some money. So you will be taxed, and you will be taxed not under salary because you're not an employee of that institution where you're teaching, but you'll be taxed as income from other sources.
Okay.
So you'll be under that head, income from other sources.
Okay.
Yeah.
Right.
Okay. So we go back to our cases and we go to the next case, which is also a very interesting case called Bhagwan Das Jain versus Union of India. And now in this case, it's a very simple case. At that point of time, when Bhagwan Das Jain case was being discussed, there was a question about income from house property, which is another schedule under the Act. And the income from house property schedule at that point of time, not now, at that point of time, we are talking about in the 50s. At that point of time, in the Bhagwasjan case, when this case came before the court, the Income Tax Act stated that, and this was section 23, as I'm saying, I'm talking about the Income Tax Act at that point of time, not now, it's been amended, but at that point of time, section 23, which is not section 23, sorry. In fact, don't worry about the section because I don't want you to get confused. The sections that dealt with income from house property, which will come from section 20 onwards, stated that a person can be taxed on a property that he occupies, has not been rented out, and is occupies, based on some notional rent, some rent, market rent that he can get from that property. So if I'm occupying a house, for example, it's my house. I'm still going to be taxed as income from house property there, although I'm not earning any income. I'm occupying the house. I'm living in my house, but it'll be based on some notional value, which might be connected to what is expected rent from that property. Since then, by the way, this was the act in Bhavanjan's case, that's how the act was. Since then, the Income Tax Act has been amended. And if you are occupying your own house, you are not taxed. Subject to certain things, you're not taxed. Normally, you're not taxed on the expected rent from that house if you occupy your own house. But at that time, that was not the case. At that time, they said that the annual value, you'll be taxed on the notional income that you get. A taxpayer went to the court and challenged it, saying that how am I being taxed on something when I've not earned anything? And the court there has said that the concept of income should be, following Mafatlal and other cases, that the concept of income should be interpreted broadly, encompassing both actual monetary gains and benefits, such as the annual value of a self-occupied house, encompassing both actual monetary gains and other benefits that you can get, which are not actual monetary gains, such as the annual value of a self-occupied house. The court concluded that taxing notional income from self-occupied property does not exceed Parliament's authority. Now, here's the thing that I find very interesting. If you go to the materials that I've given you, and you go to note 9, please, which is Bhagwan Das Jain versus Union of India, and you go to the last paragraph, and I'm going to read out the paragraph for you. The court says, even in its ordinary economic sense, the expression income includes not merely what is received or what comes in by exploiting the use of property, but also what one saves by using it oneself. That which can be converted into income can be reasonably regarded as giving rise to income. So that's very interesting. It says that which can be converted into income can be reasonably regarded as giving rise to income. The tax levied under the Act is on the income, though computed in an artificial way, from house property in the above sense, and not on house property. And the levy in question falls under entry 82, which is interest tax on income of list 1 of the 7th schedule to the Constitution. In some ways, this case is interesting and also important for us because it appears to even take the idea of income even further, because now it's saying, because if you remember in the Mafatlal case, it said that income is whatever comes in, and we took that to mean some actual tangible benefit that the taxpayer has received. And we thought that's wide enough for income. This actually takes the concept of income even further, because it says income is not just what comes in, but also what one can save by using it oneself, right? So that which can be converted into income. So you could have rented it out. You didn't. You were sitting on it because you occupied it. Even then, because you could have rented it out and you could have earned income, that itself means that it could reasonably regarded as giving rise to income, right? So that's an interesting, very interesting, very interesting case, because it kind of extends the idea of income even further, and makes it look like even notional. By notional, we mean is we haven't really received anything, but he could have received something, and that would be considered as income, right? That's fascinating, I suppose, and we should think about it a bit more. But now let's move on to, unless somebody has any, I'm just going to see if somebody has any questions or comments or anything here that, and then I'll just move on. Of course, I'm going to get all this. I'm going to put all the threads together, but I'm just trying to see if somebody had anything else that to say. Okay, we'll move on then. And the next case is the case of Commission of Income Tax versus GR Karthikeyan. And in this case, the assessee won the first prize in a car race and received a total sum of, at that point of time, it was a big sum of 22,000 rupees. And the income tax officer included the same in the income of the assessee. And the idea was under 2 clause 24 of the 1961 Act, there is 2 clause 24, which defines income. There is just give me a second. Yeah, 2 clause 24, clause 9 says any winnings from lotteries, crossword puzzles, races, including horse races, card games, and other games of any sort, or from gambling or betting of any form or nature. And the question was whether this could be considered as coming within that clause. And the taxpayer's idea was that this winnings from lotteries, etc., would only include gambling and not games of skill like car racing. But the court said no, this income from any competitive activity may qualify as taxable income and not just gambling. And they also highlighted that the term income is of a wide category. It encompasses any receipt that represents the gain, and they specifically mentioned that in para 4, which I'm going to read now. So this is the case, note 10, Commissioner of Income Tax Madras versus GR Karthikeyan, and in para 4, the court says, the definition of income in section 2 clause 24 is an inclusive one. Its ambit, in our opinion, should be the same as that of the word income occurring in entry 82 of list 1 of 7th schedule to the Constitution. And therefore they said, and Bhagwan Das case, they said, of course, have also made a similarly liberal idea of income, and therefore income should be taxable. Now, if you say that the definition of income in section 2 clause 24 is an inclusive one and should be the same meaning as that of the word income in entry 82, and you know that the word income, according to the Bhagwan Das, according to the Mafatlal case, income means anything that comes in, and according to the Bhagwan Das case, not just income that actually anything that comes in, but anything that could have been earned, right? Anything that that's not just tangible, but also something that's notional. Well, if that is the case, are there really any limits to the idea of income, right? Is there anything that is preventing us from what's the point? So this is what I want you people to think about. Just go through the GR Karthikeyan case for 5 minutes. And this is the question I want you to answer when I come back. I'm going to give you 5 minutes. After the GR Karthikeyan case, is there a point? Is there any point to defining income under the Income Tax Act? I'll repeat my question. After the GR Karthikeyan case, is there any point to defining income under the Income Tax Act? Yeah. 5 minutes. I need an answer when I get back. Yeah, I'm back. Who wants to start? And either chat box or on the audio place. Yeah, but you'll have to raise your hand so I can look at you. And if I'm not answering your raised hands, you could speak up as well. But please identify yourself. The question I had for you was, after the case, is there a point? Vivek, yes, Vivek. Vivek, you're muted. Yeah.
Yes, sir.
Yes.
Yes, sir. In this case, it was shown that anything that can properly be described as income is taxable under the Act, under expressly exempted.
Yes. Anything that comes within the constitutional definition of income under the schedule would be considered as income under the Income Tax Act as well. And why? Because Income Tax Act is inclusive. The definition of in 2 clause 24, both under the old act and the new act, it's an inclusive definition, and therefore it is wide enough to capture whatever concept you have under the Constitution. Under the Constitution, it's been captured very liberally in your Mafatlal case as well as your Bhagwandas case. Yes, go on, Vivek. So what might be the conclusion, therefore?
Yes, sir. In this case, it was included in his income, but there was that was not income. That is income from other sources. It was not income from salary or income from business.
Yes.
It was from other sources.
That's
And
right.
the section was inserted in 1947, section 12B, to
Yes.
income from other sources.
That's right.
No. That is
sorry. 12B is about capital gains. And no, but the Karthikeyan case is not about capital gains. It's about, as you rightly put it, it's about income from other sources. It's about income from car racing. So, do you think there's a limit, or do you think there's no limit? I mean, in other words, do we need a definition of income at all, or not? That's what. So, Raj Nandini, do you have something? You raised your hand. Yeah.
So after seeing this judgment, we can come to a kind of conclusion that any gain, be it real or deemed, be it the real or the notional gain, to the flowing to the taxpayer, we can say it is, and enriching the taxpayer economy, we can say falls under the income.
Yeah, that's right. I mean, that's what I would think. But then there's really no restraint, no? At least under the definition of income, there seems to be no.
Exactly, because it's an inclusive one.
That's right. So, and Dutt has also said the same thing here. Theoretically, there's no limit. There is a limit, which is whatever is not a thing that comes in, or whatever cannot be converted into income. But practically, there's no limit, and that's right. I think that really principally speaking, appears to be no, at least in section 2 clause 24 of the Income Tax Act doesn't seem to be providing any limit. Let us do one more case, and then let's talk a little bit more about that case as well. And then I've got a few more things to talk to you about after that case is over. But let's do that case first. Yeah. Now, this case is called the Commission of Income Tax versus Subhash Kabini Power Corporation Limited. This is a Karnataka High Court case. And here, a company earned carbon credits for reducing emissions, and then they sold them to a Japanese company. The question was, what kind of gain does a business have when they sell a carbon credit? Remember, under international agreements now, there's a limit to which you can have environmental emissions, pollution emissions, and some companies, by adopting good environmental practices, are able to gain carbon credits, and they can sell these carbon credits to other companies who are polluting, but who then can say that yes, we're polluting, but since we have a carbon credit, we are still within the overall environmental limits on pollution. The question, of course, is what kind of gain does a business have when they sell a carbon credit? Right now, in your course materials, this comes under Note 11, and the revenue argued that carbon credits should be taxed as business income under Section 28 of the Income Tax Act, as they provide a benefit generated from business operations. But the court said the carbon credits represent a capital receipt exempt from tax, as they're earned from adopting eco-friendly practices rather than from business gains. And I refer you to paragraph 6 of note 11, paragraph 6, where the court is saying we cannot accept the said submission, which is that this is business income, that earning of carbon credit is not the business of the SSC, nor the same is generated as a byproduct on account of business activity of power generation, but that it is earned on account of concern for environment carbon credit, and it's generated on account of employment of good and viable practices by the SSC. Same question I have for the class, which is, I mean, in this case, the taxpayer got away with it, right? The taxpayer transferred carbon credits, got some money for it, but was not taxed. How is it that the taxpayer was not taxed? Same question I have for the class. How is it that the taxpayer was not taxed, considering that the definition of income is very wide? Is there an answer to that from the class? Yep. Who wants to answer that question? Why is it? Why? How did the taxpayer escape? Yes, Asha. Yes.
So it was not a regular revenue receipt for that company. It was out of the regular activity of this. So
Yeah.
they earned it on account of their capital investment or whatever.
Yes, that's correct. But then what do you do with this wide definition of income?
So you can treat it as capital income only.
No, I'm saying, why were they not taxed when the definition of income is so wide?
Because if I were to think otherwise, it would be because it is environmental friendly.
No. So the answer to that, my question, is related to the discussion we had previously. Anyone else who wants to jump in here and then discuss this? So my question is this. Again, this is a Subhash Kabini case. Is an interesting case. Again, the taxpayers escape tax, even though you have all this Bhagwan Das case and you have this, Karthikeyan case and all of these Mafatlal case. How is that happening? Yes, sorry. Somebody had? I heard somebody's voice.
Yes,
Vivek.
sir.
Is it Vivek, you?
Sir.
Yes, Vivek.
Sir,
Tell me.
Sir, I want to say that it was not included in income because the amount was taken for social responsibility for to compensate the environment.
Yeah, but
loss.
it's still it could be that there's some virtuous activity going on, but it's still gain. No? And we have a wide definition of income, right?
Okay.
Who wants to answer this? We kind of discussed this previously. Who wants to take a shot?
Also, the source for carbon credits.
Rohil, is it Rohil? Rohil, people have to identify
Yes,
themselves, otherwise I won't be able to figure out who's talking. Yes, Rohil. Yeah.
Yes, sir. So
Yeah.
when it comes to the source of carbon credits, I'm assuming that it's some government body that is awarding them. So
International body, that's right. Yeah. There's an international agreement under which carbon credits have been earned. Yeah.
So if there's a clause under which it says that carbon credits are tax free, then the
There's no
whole
such clause. There's
there
no
is.
such clause. There's no such clause. But okay. So let me repeat this for the class so that we're all on the same page here. I said even if carbon credits. Let me put it this way. My point in discussing this case with you, the carbon credits cases, Subhash Kabini cases, even if carbon credits result in a gain, that's not the end of the question. The question then is, can it still be taxed as business income under the business income head? The way the court has gone about it, when you read Subhash Kabini case, um, please go back and after this class read the case closely. The way the court has gone about it is to say that this is a business receipt and not a capital receipt. Asha pointed that out immediately when I asked. They're still making not just a definitional argument there, they are making what I call a schedule argument. Right? In other words, income can be taxed under the Income Tax Act, not only because it defines, it includes, it comes within the definition of income, but there must be some kind of a realization in the event under one of the schedules. Income is something that is realized or recognized under a schedule of the Income Tax Act. And there the taxpayer can still make the argument. Taxpayer can say, yes, this is something that has come in. I mean, that is made it very clear. Anything that comes in is income, or anything that is converted into income is income. All that might be true, but you still have to figure out whether that income is taxable under one of the schedules. If you're saying that it's business income, then you have to tell me why it's taxable as business income. And there the taxpayer can argue, no, this is not coming out of my business. This gain is not from my business. It's because of, as both Rohil was saying it and other people were saying it as well, that it's not business. It's more like some environmentally friendly activity that has, of course, but for the business it wouldn't have happened. But it's not realizable as business income under the business income schedule because it comes out of some environmentally virtuous activity. That's the kind of argument that the taxpayer was making in this case, and he succeeded in that argument, right? Yes, Asha.
So don't you think that this decision is ultimately contrary to that Kartikeya decision where any income is income?
Yeah, in the Kartikeyan discussion, they were still talking about 2 clause 24, the definition of income, where under which, of course, even I think a carbon credit would be considered as income. But I said that's not the end of the matter, though, because it's not just a question of you saying it's income tax authority saying it's income under the definition of income. They also have to bring that income under one of the heads. They have to say it has been realized or recognized under one of the schedules. And there the revenue ran into a problem because they could not say
Okay.
this is a realizable income, realized income under the business head. It's a capital receipt. So this whole argument of whether something is a revenue receipt or a capital receipt is not a definitional argument. It's more a schedule argument. It's an argument that it doesn't come within the business income schedule. That's an interesting part. That's how both under Maheshwari Jute Mills and under Subhash Kabini, the taxpayer got away with it. Right? They had some gain. They gained something, but then they didn't have to pay taxes on it, right? So these are all taxpayer success stories as we are talking about here. Now, having said that, we're talking about the revenue. So the revenue has since then amended the act and has incorporated a new section, which is under 115. Let me just bring up that section for you. So under 115, 115, let me just see, 115 BBG of the 1961 Act, 115 BBG of the 1961 Act, it says that where there is a transfer of carbon credits, there would be a flat 30% tax on it. Yeah, so there's a now because of this ability to of the revenue to just amend the Tax Act. They've amended and inserted a section in the 1961 Act. Don't worry about the new Act. The 1961 Act 115 BBG. And they've got a, sorry, not 30%, this is a flat tax of 10% on a transfer of carbon credits, right? And actually, when I see this section 115 BBG, I have another question for the class, which is, well, I got a few questions for the class. Let me put it that way. So now 1115 BBG is there, it's amended, and transfer of carbon credits is now subject to tax. If 11BG were not there, if 115 BBG were not there, then it would not be taxable. But let's continue. And I got a few more follow-up questions. Before that, yeah, I have one follow-up question. I think it's related to what somebody has typed in here, which is, granted that it's not a business receipt and therefore won't come under the business income, why can't it come under the capital gains schedule? Why is this not capital gains, right? And somebody has written here that it's because capital receipt falls in here because the carbon credits things is actually incidental to other power generation, may not be an ongoing business thing. That's true, but I was saying that this is because of under the business head income, under the head business income. Why couldn't the revenue capture it under capital gains? And one answer could be that there's no, the same problem we had with the loom hours question, which is we'll have to identify a capital asset and we'll have to figure out what the cost of the carbon credits was in the hands of the person who generated it. And it looks like it's, even unless there's some finality to that, unless there's some certainty to that, we can't figure out what the cost would be. Of course, we know what he got in return for it, for transferring carbon credits, but what was the cost of the carbon credits in his hands might be a problem, and therefore I think capital gains schedule also, it'll be difficult to put it under the capital gains schedule. Now I have a question for the class, which is, one of the things that we find it very quite interesting to see when we do this carbon credits kind of thing is the definition of income has not been amended to include carbon credits, right? So the definitional section 2 clause 24 has not been amended to include within it income from carbon credits, but there's a specific section now, 115 BBG, which taxes carbon credits. One question to the class is that all right? As in, is it okay to include 115 BBG and tax carbon credits at 10%, but not amend the definition of income under the Income Tax Act and include carbon credits there? Is that Asha? Yeah. Yes, Asha.
Yes, sir. Actually, if they include that as an income and start taxing it, what will be the motivation for the people to become more environmental friendly in their operations?
Yeah, you're asking a question about incentives, and I think the government's idea was, I don't know if the government thought through it, but the government's idea was that 10% is not a big tax. Usually, income is taxed at 30%, and capital gains is taxed at now 12.5%, at that time 20%. So, this is less than that. So it's a concessional rate of tax, so to speak. But that's a policy question. My question to you is, can we have 115 BBG in the Act? Mine is a more design-oriented question, a conceptual question. Can we have a tax under 115 BBG without amending the definition of income under Section 2, Clause 24? That was my question. Yeah. So Rohil, you mentioned this is not a business activity, but effort incurring cost to the company, sacrificing profits. No, but are you trying to answer this particular question I'm asking? Which is, so I'll repeat the question. Can we have section like 115 BBG, which specifically taxes carbon credits at 10%, without amending the definition of income under section 2 clause 24? That's the question I'm asking the class. Let's see who wants to answer that. Yeah, anyone? So, okay, so
I
that
think
has, sorry, I'll just read out that and then I'll come to you. So that has saying, if an item isn't definitionally defined as income at the beginning, then how can it fit under one of the heads? If the carbon credits are not income under the precedent and this is not overridden by statute, then 115 BBG is unenforceable. Parliament isn't using its full power to make carbon credits taxable. Indulekha, on the other hand, has said, yes, there is a list income from other sources, so this 115 BBG will go there. Well, okay, so one answer to this question would be, I mean, that has raised a good point, but one answer to this question would be, Parliament doesn't have to amend section 2 clause 24 specifically to include carbon credits. It's an inclusive definition. 2 clause 24 definition of income is inclusive, and because of the wide legislative authority given to the Parliament under the Karthikeyan case and other cases, the Parliament can assume that you can assume that definition of income is not an issue. The issue more is it doesn't come under business head. So then Parliament says, fine, we'll include a special clause called 115 BBH, and we will tax you under that, right? Now, then I come to Indulekha's point, which is also a really good point, which is then Indulekha saying, well, yeah, but then there is a income from other sources, 115 BG will go there. But it's not very clear to me that it is income from other sources, right? I mean, it doesn't specifically find mention in under that head either. And it could be that this 115 BBG, and there are many sections around 115, which specifically target some sources of income, some items of income or the other. And it could be that they're sui generis. They're just there. The Parliament has said we'll have a special section taxing it. And it could be that that's because of the way section 4, 5, and 14 are worded. Please listen to me carefully. This is a good, interesting point that all of you should be aware of, because of the way section 4, 5, and 14 are worded, and we have done section 4, 5, and 14 in our in our previous sessions. 4 is the charge of income tax, 5 is the scope of total income, and 14 talks about the heads of income, and it says, and I'm quoting section 14 here, save as otherwise provided by this act, all income shall, for purposes of the charge of income tax and the computation of total income, be classified under the following heads of income, and it gives you A, B, C, and D. But section 14 begins by saying, save as otherwise provided by this act. Save as otherwise provided by this act, all income shall, for purposes of the charge of income tax and computation of total income, be classified under the following heads of income. And therefore, what Parliament might well say is that section 115 BBG is one example of save as otherwise provided by this act. It's just a special provision taxing a particular item of income. Doesn't need to worry about the definition of income, doesn't have to worry about which head it falls under. But of course, all income shall. So it still mentions all income, and therefore it may be answerable to the definitional part of the act. But as you have seen, the definitional part of the act is wide enough to cover anything that comes in actually or notionally. So that's one interesting aspect that I wanted you to think about, which is these kind of sections, section 115 BBG, etc., may not even be referable to any particular head of income. They could come under the save as otherwise provided by this act part of section 14. Okay, we have actually come to the end of our session. This will be the end of our discussion on income tax. Please go and read all those cases that I've asked you to read. And when we come back next time, we will be talking about income from salary, which is the first head of income that we're dealing with. So thank you very much, all of you, and have a nice weekend. And I
Hi.
will see you. Yes, Ramdas, you. Oh, we have some people have raised their hand. Yes, please. Whoever wants to talk can talk. Yes. Yes,
So
Ramdas. Yes.
my question is that exam pattern, how will be depend on the exam for this topic?
Yeah, I mean, when you say exam pattern, I mean, whatever we learn in this class will be tested. There's no specific exam pattern. The only thing is that there'll be a multiple choice question. But your formative assessments will be multiple choice, and your summative assessments will be
So
a component of that will be essay type.
in MCQ it will be a case study or like that?
No, no, there's in MCQ it'll test your knowledge. May not be a case study. It'll just test your
Okay,
knowledge of the act.
okay. Because sir, I'm finding it difficult to get understand because I'm not from a law background, so I'm not getting that sections and all that thing. So that's why.
Yeah, but you well, see, this is what you need to do. Don't worry about that. We don't even assume tax knowledge or legal knowledge on your part. But you have to do the work, though. You'll have to read through the cases that I've asked you to read,
Right.
and look at those sections again in your spare time. Look at those
Okay.
sections and lesson reports.
Okay.
Yeah.
Thank
Don't
you.
worry, you'll get used to it. It's of course you'll have to do that work, but you'll get used to it.
Okay. Thank you.
Yeah, somebody else had a question.
So basically, in
Yes.
this case, um, the Japanese company is a supplier to the company that is selling the credits.
No,
That
no,
is
it's not. It's not. It's not. It's not. The unrelated parties.
okay. So even if it is unrelated, is it possible that if he sells carbon credits to them and instead of cash remuneration, he takes remuneration in terms of some sort of coupons of that company,
From the Japanese
then
company.
yeah,
Yes.
where it can avail any service from them and reduce those coupons from them. In
Yes,
those
yes.
cases, is that carbon credit taxable?
Yes, it will be taxable. The only problem here would be how to value it. There'll be a valuation problem. If the valuation
Correct.
is easy, if the coupon has a
Hmm.
monetary, easily understandable monetary value, it'll be 10%
Hmm.
of that.
Okay. But in the event it's not, then probably
You'll
not.
have a dispute with the income tax department.
Got it, sir.
Yes, anybody else had a question? Asha, if he has raised her hand.
No, sir. Sorry, it is for the earlier one. I'll lower it.
Sure. Okay, great. Thanks a lot, all of you. And I will see you 2 weeks from now. Thank you.
Thank you, sir.